Biggest U.S. banks by asset size are holding on to a combined $1.5 trillion in cash. It's almost 70% more than Citigroup, J.P. Morgan, Wells Fargo, and Bank of America held a year ago. Why are these banks hoarding then so much cash, especially Citigroup, which has yet to repay the U.S. taxpayer for the bailout? Joining us now is Dan Alpert, Managing Director of Westwood Capital, and Charles Bobrinskoy, Vice Chairman and Director of Research at Ariel Investments. Gentlemen, thanks for coming on. Let me start with you.
Thanks for having us.
Let me start with you, Charlie, because I've been talking with Dan here all morning. What do you think about the amazing amounts of money that these banks are holding? Citigroup in cash, holding $244 billion, almost $250 billion.
Yeah, I don't like the word hoarding. It's a pejorative. It implies that in some way they're doing something wrong. A couple things going on. One is that despite Citigroup's problems, people have viewed federally guaranteed banks as a safe place to put money. So they have had good deposit growth. The second thing is that they came very close to the edge last year. They had a near-death experience, and when that happens, it focuses the mind, and they're not going to allow themselves to go under. So they are keeping very safe levels. And third, frankly, they're not finding a lot of very attractive places to lend money. They're nervous about the economy, and they've got lots of good credits that don't need more borrowing.
Dan, let's bring you into this. I mean, the amount of money that Citigroup's holding on to makes sense in your view?
Well, I think the amount of money that all banks are holding on to makes sense in my view. The fact is that Mr. Greenlee testifying today before Congress made a comment that bank assets continue to deteriorate. The picture is not very, very good. Banks have an enormous amount of cash set aside. They've deposited, by the way, an enormous amount of that, about $800 billion plus at the Federal Reserve Bank, or at several Federal Reserve Banks around the country. And that's a good thing for the banks because, unlike before, they're getting interest on it. But there's this huge dichotomy between the cash that banks are hoarding, which, as Charles just said, they don't see a lot of loan demand. And we should get into that in a second.
That's interesting.
Yeah, it's very, very interesting. But here's the other part. The fact is they also need to have adequate capital, and that's the interplay right now. I mean, cash and capital are two different things. And right now we're faced with a situation in which banks are seeing future loan losses down the pike. They want to make sure that they're liquid enough in order to meet those problems as they come up. But by the same token, there is a reasonable expectation that if those losses become worse and more worse than people think,
so this is exactly
we're going to end
what
up
we
with
wanted
a
them to be
capital
doing a year ago,
well,
or 2 years ago, or 3 years ago, correct?
Of course. The whole problem with the banking crisis is that banks were operating on too shallow a pool of capital. That's exactly what caused this problem to begin with.
Although if they had started this 2 years ago or 3 years ago, it could have triggered the same thing that happened eventually anyway. Right?
And of course, he wouldn't have had all those lovely bank earnings.
Let's start by talking.
No, but that's important. If they had behaved this way, being much more disciplined in how they were lending money, we wouldn't have had a lot of the problems we were having now. We wouldn't have lent money to the subprime borrowers who are borrowing. We wouldn't have lent money to the people that can't repay their credit cards. We wouldn't have had so many LBOs. So the way that we're working now with better lending discipline is actually a positive, I think, in the long run.
Let's talk about lending discipline. I mean, is it all about that, or is a lot of it about currently demand as well? Because we hear on the one hand from so many people that small businesses aren't getting enough loans, they need more, and on the other hand, Dan points out there's not a lot of loan demand right now. I mean, what does the picture really look like?
It's actually kind of simple here. Those with credit have money. Those without credit don't. And it's pretty simple. Companies that have very, very good balance sheets, that are well capitalized, those companies are not big borrowers. They're in fact themselves hoarding cash. Hoarding,
although
bad word. Sorry, we're not using the word hoarding, right? But they're building up enormous holding cash because they don't see anything to spend it on in a recession. Smaller businesses, which are the lifeblood of this economy, of course, can't access and probably shouldn't be able to access capital from banks simply because their creditworthiness is terrible right now.
Charlie, sounds like you want to jump in here.
Let me critically say that small business is also not a big customer of the banks we're talking about here. Citibank and J.P. Morgan don't have much of a market share in the small business market. Those people tend to be customers of regional banks who, frankly, don't have these massive cash hoards.
Or so folks like CIT.
Well, that's exactly right. That's exactly right. And so Citigroup's customer would be the large IBMs of the world, and they don't need the money right now.
So let's talk about what you do then if you're the Fed. I mean, Dan points out these small businesses are the lifeblood of the economy. We hear this from economist after economist. Here, David Malpass pounding the table on this a lot. Charlie, what does the Fed do when all the big guys are holding all the cash and the little guys need it to get the economy started again?
It's not simple, but one of the things that has to happen is there's got to be more consolidation of some very troubled regional banks. So one of the things that's going on is that Jamie Dimon is holding a lot of cash so he can play offense, so he can buy some troubled banks, as are some banks that are a little bit smaller. So they're doing the right thing now, holding capital so that they can acquire troubled banks, which is going to be good for the system and good for lending to smaller business.
But Charlie, doesn't it also create even bigger, firms than before? This whole idea of too big to fail. I mean, aren't we creating ultimately even bigger firms than before?
Yeah, and actually I should be careful on that. A lot of the smaller banks that are in trouble are going to get bought by somebody other than Jamie Dimon and Citigroup. They're going to get bought by the larger regional banks who are holding some cash back. So you're absolutely right. We don't want to see more consolidation among the big three.
Let's talk for a moment about the regulation, about the legislation in Congress right now, because if Jamie Dimon and all of the big banks can play offense right now, it's going to surely get much easier for them once too big to fail is completely enshrined and they can borrow money at a much cheaper rate than anybody else, even cheaper than they already are.
Well, you know, Sheila Bair today has been, especially today, she came out with a statement saying, listen, this is unconscionable what the banking industry is doing to block meaningful reform. We have a Treasury Secretary who's out there who's basically said, we cannot escape too big to fail. And I think your comment, Carol, just before was correct. We're going to have more too big to fail. We have to put an M in front of it. But the truth is that we have 8,300 banks in this country. The vast majority of them are inconsequential from a systemic standpoint. And in fact, Charles is absolutely right. They should see some merger activity, not at the community level necessarily, but between the locals, the small regionals and the large regionals. Those institutions will consolidate. The biggest problem right now is whether we are going to be on a competitive footprint with all other countries in the world with large banking institutions.
Charlie, got 20 seconds left here. I mean, that is certainly an issue that everybody's worried about, whether or not we're going to be able to compete with some of the firms overseas.
I think we will, but we won't if we have regulations that are a lot worse than what the Germans and the Swiss face. So let's not make it a situation where people want to move their corporate headquarters to some other country.
All right, hey, Charlie, thanks so much for joining us. Charles Bobrinskoy there of Ariel Investments and Dan Alpert here of Westwood Capital. Thank you so much for joining us, gentlemen.